Over the past 2 days, the international commodities market has witnessed a major development. Australian iron ore giant BHP has finally relented, bowing to pressure and accepting renminbi settlement. Consider that just 1 week prior, the company had adopted a defiant stance, declaring it would never compromise and appearing determined to confront the Chinese market head-on. The outcome? China's single move to suspend purchases sent BHP's share price tumbling, leaving it with mountains of inventory and watching its largest buyer slip away. After merely 7 days of struggle, the company made a complete about-turn, dutifully signing the agreement. This seemingly brief standoff reflects over a decade of strategic planning by China. We employed not impulsive hardball tactics, but a methodically executed open strategy. The turning point occurred on September 30, 2025. That day, China National Mineral Resources Group issued a directive instructing domestic steel mills and traders to completely suspend purchases of BHP iron ore priced in US dollars. The notice was brief, yet its impact was staggering. Capital markets reacted first. BHP's share price plummeted immediately. Within 24 hours, Australian Prime Minister Albanese stepped forward to express his disappointment with China's decision. It was plain to see that Australia had been knocked off balance by this blow. Initially, BHP attempted to hold firm. After all, for decades they had wielded pricing power, confident that no matter how much China protested, they would ultimately have to buy their ore. But they miscalculated one crucial figure. In the previous fiscal year, BHP's total revenue stood at $55.6 billion, with $34.7 billion originating from the Chinese market. China is their veritable bread-and-butter customer, not some minor client to be trifled with. In the face of reality, stubborn defiance proved futile. Inventory pressures, cash flow constraints, port congestion, every day of delay translated into tangible financial losses. By the 7th day, BHP could hold out no longer and bowed to accepting renminbi settlement. China's decade-long strategy culminated in this very moment. BHP's capitulation was no accident, but the inevitable outcome of China's years of strategic positioning. China had long laid its groundwork across 3 fronts. First, consolidating the demand side to end internal strife. Previously, Chinese steel mills procuring iron ore resembled a disorganized force. Each scrambled for supplies, driving up prices and allowing Australian firms to reap the benefits by picking them off individually. In 2022, China intervened by establishing a mineral resources group, consolidating procurement rights for giants like Baowu, and steel and Minmetals. Nearly 40% of the nation's iron ore demand was now wielded as a single unified force. From then on, China held the upper hand at the negotiating table. Secondly, diversifying supply chains to break monopolies. China has signed long-term agreements with Brazil's Vale, increasing renminbi settlement to 28%, while simultaneously investing in Guinea's Simandou iron ore project, the world's largest undeveloped deposit with reserves exceeding 29 billion tons, slated for production by late 2025. Moreover, 48% of Russia's iron ore exports to China are settled in renminbi, priced 10% lower than Australian supplies. This breakthrough in settlement currency undermines the dollar's foundation. Iron ore ranks as the world's second-largest commodity after crude oil, with annual trade exceeding $150 billion. Historically, over 80% of transactions were settled in US dollars, costing Chinese enterprises hundreds of billions annually in currency conversion fees alone. With renminbi settlement now operational, Chinese and Australian firms directly circumvent USD exchange rate risks, enjoy faster capital turnover, and secure greater profit margins. Where interests lie, there lies the most potent lever to shift reality. BHP's concession has toppled the first domino, sending shockwaves through 3 nations. First, the United States, a crack in the dollar's hegemony. Settling iron ore in renminbi undermines not just prices, but the very foundations of dollar supremacy. The dollar's global taxing power stems from its peg to commodities like oil and minerals. Now, with Australia, a staunch U.S. ally, seeing its enterprises defect first, a hole has been chiseled into the dollar system. Data reveals that in the first half of 2025, the renminbi's share of cross-border trade surpassed 8%, doubling from the previous year. JP Morgan forecasts this figure will double again within the next 5 years. While the Trump administration maintains a surface silence, Treasury Secretary Steven Mnuchin has publicly stated they are closely monitoring renminbi trends. The dollar's influence is being gradually diluted. The last time nations proposed settling commodities in non-dollar currencies was years ago with Libya and Iraq. The outcome? Regimes toppled, leaders assassinated. Both nations remain mired in conflict and poverty to this day. Evidently, settling commodities in domestic currencies involves military considerations alongside economic ones. Second, Australia, economic reality overrides political stance. Australia now finds itself in a predicament. On one side lies American pressure, on the other its lifeline of iron ore exports. Previously, it profited handsomely from its resources, selling low-cost ore to China at tenfold premiums. Now that China has reduced purchases, mining firms from Brazil, Russia, and Africa are scrambling to fill the void. Australian firms like Rio Tinto and FMG are already watching closely and may well follow suit with renminbi settlements. After all, businesses must survive, and markets wait for no one. Third, resource exporting nations, a new model of cooperation emerges. Malaysia's tin mines, Indonesia's nickel deposits, Middle Eastern oil companies, all are closely monitoring this strategic shift. When a hard currency underpinning $150 billion in annual trade begins its de-dollarization, how could other commodities remain indifferent? European manufacturers have already tentatively inquired, can we discuss renminbi settlement? This is not a de-dollarization revolution, but the establishment of a multi-currency ecosystem. As China has stated, only a diversified system can safeguard global supply chain security. The internationalization of the renminbi, a slow yet enduring triumph. Settling iron ore in renminbi marks not an endpoint, but a starting point. It demonstrates 3 truths to the world. First, China is no longer a passive buyer, but a participant and shaper of rules. Second, behind its market scale lies strategic resolve and positioning capability. Third, the ultimate logic of global trade is mutual benefit, not ideological stance. Today, Brazil's Vale and Australia's Rio Tinto have embraced renminbi settlements. FMG has even applied for a 14.2 billion yen loan from a Chinese banking syndicate, pledging future iron ore shipments as collateral, actively tying themselves to the Chinese market. This 7-day battle may appear superficially as China securing price advantages and settlement rights, but fundamentally, it signifies China reshaping global commodity rules through sheer strength. BHP's capitulation marks not an end, but a breakthrough. The ice has cracked for the renminbi's internationalization. More sectors and nations will now choose to conduct business on their own terms. This is not a swift victory, but a slow and enduring triumph. A new chapter in global trade is unfolding, page by page, penned by China itself, beginning with iron ore.